Hello and welcome students to my YouTube channel. In the last video lecture, I had explained you the terminologies of accounting. In that we have done 24 terminologies of accounting. Out of total 46, we had completed 24. Now moving on with the remaining terminologies, let us continue with it. As you can see on the board, I have written the 25th terminology of accounting, that is profit. Now, what is profit? And the second term, that is loss. If the amount of income is more compared to the expense, it means the amount of receipt is more compared to the payment, excess of income over expense, then it is called as profit. Now, excess of income or expense means from the daily routine expense, regular expense, compared to the regular expense, the regular income of the company or the firm is more than that increase in income compared to its expense is called the profit. And this profit or loss can be known by preparing the profit and loss account at the end of the accounting year. Already I discussed which is the accounting year, that is 1st April to 31st March. So at the end of the accounting year, it means every 31st March, any firm or company form of organization will be preparing their books of accounts in order to know the financial position of the business. So over here, the profit or loss of the firm or company is determined by preparing the profit and loss account. So excess of revenue receipt compared to the revenue payment is called the profit. Already we discussed what is revenue and what is capital receipt, revenue payment and capital payment in the last video lecture. Okay. In the same way, loss. Loss is totally opposite of profit. If the expense is more, excess of expense over income, then it is called as loss. It means the revenue payment is more, the payment which is on regular basis, that is called revenue. And in the same way, revenue income or the revenue receipt, it means the income received on regular basis, then it is called revenue receipt. So if the revenue payment is more compared to the revenue receipt, then it is called as loss. Okay, this also we can know only by preparing the profit and loss account at the end of the accounting year. Next comes, that is gain. Gain is just the synonym word of profit. It means in case of profit, we can the another terminology that is utilized, that is gain. Both are one and the same, that is profit and gain. Okay. Next one, 28th terminology, that is purchase. Now what is purchase? Many items or services are purchased in the business. Now to manufacture the goods, the businessman or the firm or the company requires certain kinds of raw material. So that raw material or the workers are required in order for the manufacturing of the goods. So that raw material which we are purchasing or whatever the services of the laborers that we are getting for the manufacturing of goods, that is called purchase. Okay, so many items or services are purchased in the business, but only the goods that we are purchasing for the manufacturing of the finished goods, that comes in the category of purchase. Okay. Next one is sales. Just as purchase, same way there is opposite, that is sales. Income generated by sale of goods is called sales. If we are after manufacturing, after purchasing of the raw material, we are manufacturing the finished goods, and that finished goods we are selling out in the market. So income generated by selling of the finished goods is called as sales. Okay. Next comes, that is stock. Now what is stock? Goods remained unsold from the goods purchased is called stock. Now whatever the goods that we have purchased, raw material that we have purchased, we have manufactured the finished goods, and out of that finished goods, certain amount of certain amount of goods have not been sold out at the end of particular accounting year. Suppose we have manufactured 1 lakh unit of goods, and out of that 1 lakh unit of goods, 75 25,000 units of goods have been sold out. So at the end of the accounting year, what would be the stock? That is 25,000 unit of goods, that becomes the stock. It means the goods that are lying with us, that is not sold out at the end of the accounting year, that is called the stock. Okay. Next one, that is debtors. When a businessman sells goods on credit, already we discussed what is the meaning of cash transaction and credit transaction. Now this debtor and creditors relation arises only when the goods are purchased or sold on credit. If we have made the payment immediately or received the payment immediately, then no any relation of debtor or creditor would arise. It will arise only and only if we have sold the goods on credit. Okay. So when a businessman sells goods on credit, now why the businessman requires to sell the goods on credit? There are certain reasons. In order to sustain in the market, in order to increase the sale of its product in the market, in order to earn more profit, in order to increase its goodwill in the market. These are some of the reasons because of which it has to provide goods to certain customers on credit. Okay. So when a businessman sells goods on credit to his customers, those customers becomes debtor for the business. Then those customers who have not made the payment at the time of getting the goods, but have given the guarantee to pay the amount after a stipulated time period, say 3 months or 6 months, then for that time period they become the debtors for the business. It means it becomes the current asset. Debtors are included in current asset because in future that much amount is receivable from that particular customer. So it becomes our debtor, it becomes our receivable. Okay. Next one, that is bills receivable. Now what this terminology is new for you, that is bill receivable. I have written short form. In exam also you can write this short form only, B/R. You don't need to write the full word, that is bills receivable. B/R, bills receivable is a written document. Now bill receivable is a written document. It is an agreement between both the parties. Whenever another party or the customer is not paying the amount in cash, but after a stipulated time he gives the guarantee to make the payment, at that time this document, that is bills receivable, is created between both the parties. So bill receivable is a written document where one is bill writer and the other is bill acceptor. Now who is bill writer? Who writes the bill? The person who has to collect the money from the customer, who has to get the amount of money after a stipulated time period. That person writes the bill. It means the person who is going to receive the money, for him, he becomes the bill writer. And the person who has to make the payment after a stipulated time period, that becomes the bill acceptor. Who has to make the payment, that becomes bill acceptor. He gives the assurance. He signs the bill and he gives the assurance that after 3 months or 6 months he will make the payment, though he gives the guarantee. So it becomes bill acceptor. And bill writer, it means the person who has to get the money from the customer, who provides the goods on credit to the customer. Okay, so it is a written agreement between the bill writer and the bill acceptor. Okay, next one, that is receivable. Any amount to be received by businessman in future from any person. Now any amount which is to be received by the businessman in future from any person. Now what is the difference between bills receivable and just receivable? Bills receivable means only the goods are sold on credit. Over here not only goods comes, but also any kind of income. Suppose outstanding income, in future we have to receive certain amount of dividend or commission from any other third party or customer, then that is also included in the category of receivable. Outstanding income or prepaid expense. Prepaid means we have paid the expense in advance. Suppose our accounting year is 1st April 17 to 31st March 2018. Okay, this is suppose our accounting year. So if the expense of the next year, that is of 31st March 19 also, that we have paid in the current year, that is 31st March 2018, then whatever the expense that we have paid of the next year, that becomes the prepaid expense. So in next year, when the actual accounting year, that is 1st April 18 to 31st March 19 will occur, at that time we don't require to make that expense again, because that expense already we have paid in advance. So it is called prepaid expense. It is what written in short form, that is P.P, that is prepaid expense. In the same way, outstanding income. Outstanding income means the income that is to be received in future from the third party or the customer. In the current year, that income has arisen, but the third party or customer is not in a position to make payment at that particular time. Then that becomes outstanding income, which is to be paid by that party in future. So these two topics, that is outstanding income and prepaid expense, are included in receivable, because of which the difference arises between these two terminologies, that is bills receivable and just receivable. Okay. So after completing 33 terminologies, let us move on with the 34th terminology. Just as there are debtors, in the same way there are creditors also. A person from whom goods are purchased on credit. Over here, the goods were sold on credit in case of debtors, but in case of creditors, goods are purchased on credit. Suppose we have purchased the raw material or any kind of machinery, then we are not making the payment of that goods immediately, but we are asking the time limit after 3 months or 6 months to make the payment. Then it becomes the credit transaction, and the relation that arises between both the parties, that is of creditor and debtor. So in that case, we as a businessman becomes the creditor for business. That person becomes creditor for business who has provided the goods on credit to us. So that party who has provided the goods on credit to us, that becomes the creditor for business. It means in future we have to make the payment to that customer. Okay. Next one, that is 35th terminology, that is bills payable. Now bills receivable, it becomes for the bill writer. There are two parties, right? Bill is a written document. Already we had understood bill is a written document. It is a guarantee given by the bill acceptor to the bill writer that he is going to make the payment after a stipulated time period. Okay. Now it becomes bills receivable for the person who writes the bill, and it becomes bills payable for the person who accepts the bill. Okay. So amount to be paid by business in future to any person. Bills payable. Bill is a bills payable for bill acceptor. Now the person who accepts the bill, who gives the guarantee, who signs the terms of the bill writer and agrees to pay the amount or gives the assurance to pay the amount at a later date, then that party who signs the bill, who gives the guarantee to make the payment, for him it becomes bills payable, because in future he has to make the payment of that bill. So it becomes bills payable for bill acceptor, who is accepting the bill, and for the person who writes the bill, for him it would become bills receivable. Okay. Later one chapter is coming to you regarding bills receivable and bills payable. So you will understand that bills of exchange concept very well in that chapter. At present we are understanding only the terminologies, that is what is bills receivable and bills payable. Okay. Understood? Now next terminology, that is payables. As there is receivables, same way over here that is payables. Now what is the difference between bills payable and just payables? In case of bills payable, it was a transaction related to goods on credit. Okay. But in case of payables, amount to be paid by business in future to any person. Suppose it is outstanding expense or income received in advance. Outstanding expense means the expense which is to be paid in the current year, but that expense we have not paid in the current year, but it is outstanding. So in next year we are making the payment of that expense. Suppose salary of this month of any of the worker, or dividend expense or commission which is to be paid. or interest of loan, that is to be paid for the current year, but that has not been paid in that particular current year, then it becomes outstanding. So it becomes our liability to pay to the third party in future. So these topics are included in payables, that is outstanding expense. Okay. Next one, that is cost. Whatever expenses are made to produce any product or service. Now whatever the expenses that we are making, many kind of expenses we have to make in order to run the business, in order to manufacture the goods. We have to provide various kind of salaries to the workers, wages to the workers, even various kinds of other expenses, that is telephone expense, stationery expense, even we have to pay the interest on loan if we have taken the funds from the third party. So these are all the expenses that on regular basis we have to make. Whatever the expenses that we are making on regular basis in order to manufacture the goods, that comes in the category of cost. It means whatever expenses are made to produce any product or service, that are included in cost. Next comes, that is voucher. Voucher means a bill, a written document. Just as bills receivable and bills payable is a written document, in the same way voucher, a receipt, we can call this as receipt. When we go to purchase any of the product, then generally we demand a bill. So it is a one kind of receipt, a kind of proof, that is called voucher. Okay. Voucher is a written document of business transaction. It means at the end of the year, on the basis of the voucher only, the audit or the checking of the books of accounts is being done. So it is a proof of whatever the transactions that have taken place during a year. So always it has been, even you can see in the advertisements, it has been insisted by the government also to ask for the voucher, and even it is insisted to the businessman to provide the voucher for the fair dealing of the transactions between both the parties. So it is a written document that provides a proof. In future, suppose we want to replace that product, or if we are not satisfied with that particular product, suppose we are going to purchase a washing machine, and while purchasing the washing machine, we have got the voucher or the bill of that particular product. Now after 2 months there is some defect in the machinery of the washing machine, and we need to replace that machinery, then we should have the proof that we had purchased that particular product from particular shop. So it is a written document that gives the guarantee and assurance of our product. That voucher becomes the proof. Okay, so it is a written document of business transaction. Next comes, that is 39th terminology, discount. Now every time you might have heard while you are purchasing the products on regular basis, whether it's clothing, whether it's footwear, or any kind of goods, whenever you are going to purchase, then you are seeing the label that is 25% off, or sale of 70%, or flat 50% discount. These type of taglines or these type of words you see on the screen of the shop whenever you go to purchase any kind of product. So you are interested to purchase more wherever there is discount or sale on the products. Okay, so the amount deducted from the total amount at the time of purchase or sale. It means suppose you are purchasing the goods, many kinds we are going to malls, shopping malls. At that time you see that on the purchase of rupees 2000 you will get the discount of rupees 1000. So these are all the schemes that are introduced by the businessman in order to increase the sale of their product, in order to attract the customers towards their product. Okay, so that is the amount deducted from the total amount. Suppose total amount that comes to 2000, so naturally you will purchase the goods of rupees 2000. Out of 2000, 1000 will be deducted. So remaining amount that you have to pay, that is only rupees 1000. So that 1000 which is deducted from your total purchase, that is called the discount. So ultimately it will be beneficial to both the parties, because discount always the businessman will provide, keeping certain amount of margin of profit only. Due to discount, the businessman's margin profit will be reduced, but never the businessman will provide such kind of discount that loss will occur to the firm. It will reduce the margin of profit while providing discount. Okay, so ultimately it will increase the sale of the businessman, and on the other side it will provide the benefit to the customer because it has to pay less amount compared to the actual selling price. Okay, so discount is the term or the amount that is deducted from the actual selling price. Now, in case of discount, there are two types of discount that you can see in your textbook also, that is trade discount and cash discount. Now, what is the difference between trade discount and cash discount? Businessman deducts certain percentage oblique amount from sales price. Now, suppose the total sales price is, while you go to purchase, and the total sales price comes to rupees 5,000. Now, on 5,000, suppose the seller, while you have purchased the goods in lot, so he will give certain amount of discount on his own. So 5,000, suppose he gives 2% discount to you, then it would come to 100 rupees, right? So 5,000, 2% discount, then naturally remaining amount only you will be paying, so 100 rupees you will deduct. So remaining you will be paying only rupees 4,900. Okay, so that trade discount which businessman deducts from the total sales price, maybe it may be certain percentage or certain amount. Here I have given the example in case of percentage, that is 2%. It may be suppose directly 100 rupees or 200 rupees he may deduct from the total price, then that is called trade discount. Okay. Now, this trade discount will never be recorded in the books of accounts. In any of the entry, if it is given in the question that deduct 2% discount, trade discount, then always after subtracting that trade discount, whatever the net price comes of the product, that is only to be recorded in the books of accounts. It means never the value of trade discount is to be disclosed in the books of accounts. Okay, so after deducting the value of trade discount, whatever the net price comes, that is only to be mentioned in the books of accounts. Now, what is cash discount? To attract customers for immediate payment, certain amount is deducted. It means you are knowing that there are many credit transactions required in the business in order to remain in competition with other businessmen, or in order to sustain in the market, to maintain their customers, they need to provide the goods on credit. But there are risk factors also associated while we are providing the goods on credit. So in order to avoid or to minimize that risk, it is better to provide a discount for getting immediate payment. It means in order to attract the customers to make immediate payment, suppose the total selling of the goods to any particular customer that becomes to rupees 5,000. Now that customer insists that I'll make the payment after 2 months to you. So at present we are getting nothing, so it is completely at risk whether he will pay in future or not. Okay, so that becomes completely a risky transaction. But in order to avoid that risk, what the seller would do, he would tell that if you make the payment at present while purchasing the goods, then you will get 10% discount. It means out of 5,000 worth of goods, if you get 10% on 5,000, then it would come to 500, right? So out of 5,000, 500 will be deducted if you make the payment on the spot. Okay, so now the customer has to pay only rupees 4,500 if he makes the payment on that particular time of purchasing. So naturally, if any of the customer is getting benefit, then he would desire to make the payment immediately. So in that case, he would insist to make the payment of rupees 4,500 instead of making payment of rupees 5,000. So ultimately, and the risk factor of the businessman will be reduced because he will be getting timely or immediate payment of his goods. And on the other side, the customer will also be benefited because he will get discount. Instead of paying 5,000, he has to make payment of only rupees 4,500. And so it is beneficial for both the parties. So this is called cash discount. Always cash discount will be noted down in the books of accounts. Trade discount will never be disclosed in the books of accounts. That is the main difference between these two terminologies. It will not be mentioned, and cash discount will always be mentioned in the books of accounts. Next comes 40th, that is discount allowed and discount received. Now discount allowed and discount received. Suppose we are purchasing the goods on credit, we are purchasing the raw materials on credit, and immediately we are not making the payment. But in the future time we have to make the payment. But suppose out of that total, suppose we have purchased the raw material worth rupees 50,000. How much? That is 50,000. And out of 50,000, if we make the immediate payment, then 10% discount will be getting. So on 50,000, 10% it would come to 5,000. So remaining amount only we have to pay. So at that time, 5,000 which we are not paying, that becomes our discount received. It would become discount received for us because we have to make less payment. So it would be profit or income for us. Okay, so goods worth rupees 50,000 we are getting at the price of rupees only 45,000. So less price we are paying. So whatever the less price we are paying, that is profit or income for the firm. Okay, so that becomes discount received. In the same way, if we are selling the goods on credit, and if the customer makes the payment immediately, we are providing him 10% discount. So out of same example, out of goods worth rupees 50,000, 10% discount, it means that customer or the third party will provide us rupees only 45,000. So 5,000 we are getting less compared to the actual price of that product. So we are getting less price. So it is expense for us. That is called discount allowed. That is called discount allowed. So in case of selling, while selling the goods, it becomes discount allowed because we are giving that discount to third party or the customer. But while we are purchasing the goods at that time, we are paying less amount, then it is called discount received by us. Okay, so discount received is always an income and discount allowed is always an expense because we are getting less price compared to the actual price of the product. Okay. Next 41, that is depreciation. Now what is depreciation? Depreciation means suppose we are knowing the terminology what is assets. Assets means suppose machinery or furniture that we are purchasing on regular basis, not on regular basis, but after every 5 years or 10 years we need to purchase new machinery in place of the old one. Okay, so whatever the machinery that we are purchasing, after 5 years the value of that machinery will be lowered down. Naturally, suppose we have purchased one machinery worth rupees 1 lakh, or we have purchased any of the vehicle for the firm worth rupees 50,000. Then after 5 years, the value of that machinery will be reduced only. Okay, so every year certain amount of value of that machinery or that asset decreases. That decrease in the value of asset is called depreciation, and every year we are because of the utilization, but natural whatever the new machinery will be purchasing, the production capacity would be more, and day by day because of its utilization the depreciation will be occurred, the value of that asset will be reduced. So that decrease in the value of particular asset is called depreciation. Suppose in case of human being also, at the young age we are able to work for more number of hours, but as our age becomes, the working capacity decreases. So that is also one kind of depreciation. Okay, so over here depreciation is also one kind of expense for the firm, and that is to be counted on each and every fixed assets. Okay, so machinery suppose worth rupees 50,000, then it will be provide 10% depreciation on machinery. So we have to deduct 10% from the value of machinery, that would come to rupees 5,000. So that is depreciation, that is always to be calculated on any of the fixed assets. Next 42, that is bad debts. Bad debts means suppose there are we have to get the price, we have to get the money from the third party. We have sold the goods on credit to the customer, and that customer has to pay the money after 3 months or 6 months. But due to any of the reason that third party or customer is not able to make the payment, then that becomes bad debts for the firm, because now that money will not be able to be received from the customer because he is not in that financial status to make our payment. So bad debts is a loss, it is not an expense. it becomes loss for the firm, because whatever amount we were going to receive in future, whatever it would become a debtors or receivable for us, now at present we are assured or certain that that financial status of that particular customer is not in a position to make the payment to us, so we are not able to receive the money from that third party, then at present we are considering it as bad debts. It means it is a loss for the firm due to not able to receive the money from the customer to whom we have sold the goods on credit. So that is called bad debts. It is a loss for the firm. Next, 43rd, that is solvent, and 44th, that is insolvent. Now what is solvent and insolvent? Solvent means the financial status of the firm is sound enough to make its regular payment. It means the assets of the firm is more compared to its liability. So that is called the sound financial position of the firm in order to make regular payments of its firm. So that is called a solvency. That is called a solvent firm. It means that kind of solvent firm is having a very good goodwill or reputation in the market, seeing his financial status. And insolvent or insolvency, it means the person who has declared himself insolvent, who is not having a sound financial position. It means he is not able to make his payment on regular basis because of inefficiency or lack of proper financial income. He is not able to make his proper payment on a regular basis. Then that type of person is called as insolvent, whose assets are less and whose liability to pay or responsibility to pay is more compared to its assets or income. Then it is called as insolvent. Okay, that is called poor financial status of the firm. Now the last two terms that I have written over here, you can see that is 45th term, that is debit and credit. Now what is debit and credit? These are the two main important terminologies for the entire 2 years. In fact, till the entire career of your commerce field or stream, that you will be in touch with these two terminologies, that is debit and credit. So it is very important terms that need to be understood. Now debit and credit. Debit means whatever, while preparing any of the account, whatever the entries we are writing on the left hand side, always it will be known as debit side, and whatever the entries will be writing on the right hand side of the account, that is called the credit side. Okay, in Gujarati we call it udhar and jama. Debit means udhar and credit means jama. Okay, and the short forms always we are writing for debit, that is DR, and for credit, that is CR. So generally we write the short form of debit, that is DR, and for credit, that is CR. Okay, so debit and credit. Now the last terminology, that is account. Now at the suppose there are many transactions taking place of purchase or sell or with any of the third party. Suppose the name of the third party is Amit, and that party or that person during the year 10 to 15 times we have purchased or sold the goods to that particular third person, that is Amit. Then we cannot remember on which date how much amount of goods we have sold or purchased to that third party. So in order to record that particular transactions of that particular person, we are made accounts for it. Whatever we are purchasing or selling to that third party, for that we are maintaining separate accounts, and whatever the transactions that we have done related to that third party, we are recording in that account only, so that at the end of the accounting year, while writing the books of accounts, we can get easily the idea of how many number of transactions and of what amount we have done with that particular party. So if we are having 15 transactions of purchase, then we'll be preparing separate purchase account, wages account, salary account. It means all the kind of expense account, income account, assets account, or any kind of liabilities account. We are maintaining separate accounts for each of the transaction of the business. So in order to get easily the data related to that particular transaction. So that is the last terminology, that is the account. So that's all for today, students. Today we have completed all the terminologies of accounting. Do refer again from the video lectures, because this is very important terminologies. On that basis only will be able to understand the further chapters. Next, that's all for today. Thank you, students. Goodbye. Take care. Stay blessed.